Welcome back to Chat ETF. Today we're diving deep into the BUG ETF, also known as the Global X Cybersecurity ETF. This ETF tracks companies at the forefront of cybersecurity, a booming industry. But is BUG the right bug to catch for your portfolio? Let's uncover its secrets. We'll explore what the BUG ETF actually invests in, how it measures up against similar options, and even some creative ways to potentially replicate its exposure with a little options magic. So buckle up, because we're about to get bugging with cybersecurity investing. Question 1. What is BUG ETF? BUG ETF, also known as the Global X Cybersecurity ETF, is an exchange-traded fund, ETF, designed to provide investors with exposure to companies involved in the cybersecurity industry. Here's a breakdown of what BUG ETF offers. Investment objective: BUG seeks to track the performance of the INC Cybersecurity Index. This index comprises companies globally that stand to benefit from the growing demand for cybersecurity solutions. These companies develop and manage security protocols to prevent cyberattacks on systems, networks, applications, and devices. Investment strategy: BUG is passively managed, meaning it replicates the holdings and weighting methodology of the underlying INC Cybersecurity Index. The ETF typically invests in at least 80% of the index constituents, aiming to mirror its performance before fees and expenses. Benefits: industry exposure: BUG offers a convenient way to gain exposure to the growing cybersecurity sector. Investors can participate in the potential growth of this industry without needing to research and select individual cybersecurity stocks. Diversification: BUG provides instant diversification across various cybersecurity subsectors within a single investment. This helps mitigate risk compared to putting all your eggs in one basket by picking individual companies. Liquidity: ETFs generally trade throughout the day like stocks, offering investors flexibility to buy and sell shares readily. Question 2. What is the specific investment objective of the BUG ETF? What market segments or industries does it target? The BUG ETF, or Global X Cybersecurity ETF, has a specific investment objective centered around capturing the growth potential of the cybersecurity industry. Here's a detailed breakdown. Investment objective: track index performance. BUG seeks to deliver investment results that generally correspond to the price and yield performance, before fees and expenses, of the INC Cybersecurity Index. This means the ETF aims to mirror the performance of the chosen index as closely as possible. Targeted market segments and industries. Focus on cybersecurity. The INC Cybersecurity Index, which BUG tracks, focuses on companies directly involved in the development and management of cybersecurity solutions. These solutions help prevent cyberattacks on various systems, networks, applications, computers, and mobile devices. Industry breakdown: the index might encompass companies from various subsectors within the broader cybersecurity industry. Here are some potential areas of focus. Network security: companies providing firewalls, intrusion detection/prevention systems, and secure network infrastructure solutions. Cloud security: businesses offering cloud-based security solutions for data protection and access control in cloud environments. Endpoint security: companies specializing in endpoint security software to protect individual devices like laptops and mobile phones from malware and unauthorized access. Application security: businesses developing solutions to secure applications from vulnerabilities and cyber attacks. Identity and access management, IAM: companies focusing on IAM solutions that manage user access and permissions within systems and applications. Question 3. Is BUG an index-based ETF that tracks a specific benchmark, or is it actively managed by a portfolio manager? BUG, Global X Cybersecurity ETF, is an index-based ETF that tracks a specific benchmark, the INF Cybersecurity Index. This means the ETF is passively managed and does not rely on the decisions of a portfolio manager to select its holdings. Here's a breakdown of BUG's management style. Passively managed, BUG doesn't have a dedicated portfolio manager actively researching and selecting individual stocks. Instead, it follows a predetermined strategy based on the chosen index. Index replication, BUG aims to replicate the holdings and weighting methodology of the INF Cybersecurity Index. This means the ETF typically invests in at least 80% of the companies within the index, with each company's weight in the ETF mirroring its weight in the index. Benefits of passive management. Passively managed ETFs like BUG generally offer lower expense ratios compared to actively managed funds. This is because they don't incur the costs associated with a dedicated portfolio management team. Additionally, passively managed ETFs can potentially provide efficient market exposure, aiming to reflect the overall performance of the chosen index. Comparison with actively managed funds. There are also actively managed mutual funds or ETFs that invest in the cybersecurity space. These funds employ a portfolio manager who actively researches and selects companies they believe will outperform the broader market or a specific benchmark. While actively managed funds can potentially outperform the market, they typically come with higher expense ratios due to the management fees involved. Question 4. What is the underlying investment thesis behind the companies or sectors the BUG ETF targets? The underlying investment thesis behind the companies and sectors BUG ETF targets centers around the growing demand for cybersecurity solutions driven by several key factors. Increased cyber threats. The digital landscape is constantly evolving, creating new vulnerabilities and attack vectors for cybercriminals. Businesses and individuals alike face a growing threat from malware, ransomware, data breaches, and other cyber attacks. As our reliance on technology increases, the potential impact of cyber attacks also rises. Businesses with sensitive data or critical infrastructure are particularly vulnerable, and successful attacks can lead to financial losses, reputational damage, and operational disruptions. Rising costs of cybercrime. The cost of cybercrime continues to rise globally, creating a significant financial burden for businesses and governments. This motivates organizations to invest heavily in cybersecurity solutions to protect their assets and data. Regulatory landscape. Regulatory requirements around data privacy and security are becoming increasingly stringent worldwide. These regulations mandate businesses to implement robust cybersecurity measures, further fueling demand for relevant solutions. Cloud adoption and IoT. The growing adoption of cloud computing and the Internet of Things, IoT, creates new security challenges. BUG might target companies offering solutions to secure cloud environments and protect interconnected devices within the IoT ecosystem. Evolving technologies. Cybercriminals are constantly developing new techniques, so the cybersecurity industry needs to keep pace. BUG might provide exposure to companies that specialize in innovative solutions like artificial intelligence and machine learning to combat evolving cyber threats. Overall, the investment thesis behind BUG is that the growing need for robust cybersecurity solutions will drive the growth of companies operating in this space. The ETF aims to capture this potential by tracking an index that encompasses businesses across various cybersecurity subsectors that are well positioned to benefit from this trend. Question 5. What is the expense ratio of the BUG ETF? How does it compare to similar ETFs in the market? The expense ratio of the BUG ETF, Global X Cybersecurity ETF, is 0.50% as of April 24, 2024. This expense ratio represents the annual fee charged by the ETF to cover its operational costs, including management fees, administrative expenses, and marketing costs. The expense ratio is deducted from the ETF's net asset value, NAV, on a daily basis, which ultimately reduces the overall return for investors. Comparison to similar ETFs. Here's how BUG's expense ratio compares to some other ETFs in the cybersecurity space. ETFMG CyberArk Cybersecurity ETF, CHKR, expense ratio 0.75%. LAT Cyber ETF, HACK, expense ratio 0.60%. CTXR Global X Cybersecurity Thematic ETF, BUGZ, expense ratio 0.80%. Observations. BUG boasts a relatively competitive expense ratio compared to some of its direct competitors in the cybersecurity ETF space. CHKR and HACK have slightly higher expense ratios, while BUGZ, another offering from Global X ETFs with a thematic focus on cybersecurity, has a higher expense ratio of 0.80%. It's important to note that expense ratios can change over time, so it's always wise to check the latest information before investing. Question 6. Is there a risk of the underlying holdings in BUG becoming illiquid, impacting the ETF's ability to be traded? Yes, there is a risk of the underlying holdings in the BUG ETF, Global X Cybersecurity ETF, becoming illiquid, potentially impacting the ETF's own tradability. Here's a breakdown of this risk and how it might affect BUG. Understanding underlying holding liquidity. BUG is an index-based ETF that tracks the INC Cybersecurity Index. This index holds a basket of companies within the cybersecurity industry. The liquidity of the BUG ETF is ultimately linked to the liquidity of its underlying holdings. If the companies within the index become illiquid, meaning their shares are difficult to buy and sell in the market, it can create problems for BUG. How illiquid holdings can affect BUG. Tracking error. When BUG needs to rebalance its holdings to reflect the target weightings of the INC Cybersecurity Index, it might face challenges if some companies become illiquid. Selling illiquid holdings or buying new ones to match the index composition can be difficult and potentially lead to a tracking error. A tracking error refers to the difference between BUG's performance and the performance of the underlying index. Increased costs. If BUG has to sell illiquid holdings at a discount or incur higher transaction costs when buying new holdings due to illiquidity, it can eat into the ETF's overall returns. These costs are ultimately borne by investors through lower net asset value, NAV, of the ETF. Reduced liquidity. In extreme cases, if a significant portion of BUG's holdings become illiquid, it can potentially impact the ETF's own tradability. The authorized participants who create and redeem ETF shares might face difficulties acquiring or disposing of the underlying securities, leading to wider bid-ask spreads and potentially lower trading volume for BUG itself. Mitigating factors. Index composition. The INC Cybersecurity Index might be designed to focus on companies with a certain level of market capitalization or average daily trading volume. This can help mitigate the risk of extreme illiquidity within the underlying holdings. Rebalancing frequency. Less frequent rebalancing of the index could potentially reduce the risk of encountering liquidity issues during rebalancing events. Investor considerations. While the risk of widespread illiquidity within BUG's holdings might be relatively low, it's still a factor to consider, especially for risk-averse investors. If easy entry and exit from your investment are crucial, you might want to prioritize ETFs that track broader market segments or hold more liquid underlying companies. Question 7. Does the BUG ETF have a high concentration in a few specific companies or sectors, making it more susceptible to individual stock performance? The BUG ETF, Global X Cybersecurity ETF, can exhibit concentration risk due to its focus on a specific industry and potentially a limited number of holdings within that industry. Here's a breakdown of this risk and how it might affect BUG. Understanding concentration risk. Concentration risk refers to the situation where an investment portfolio has a significant weighting towards a small number of assets. In the case of BUG, this translates to the ETF's holdings being heavily concentrated in a few cybersecurity companies or subsectors within the broader industry. When a small number of holdings carry a large weight in the ETF, the performance of BUG becomes more susceptible to the performance of those individual companies. Concentration risk in BUG. Limited transparency. While the exact weighting methodology of the INF Cybersecurity Index isn't publicly available, it's likely to focus on a specific number of companies within the cybersecurity industry. This, by definition, introduces some level of concentration risk. Top holdings. You can analyze the holdings information for BUG, typically available from financial websites or directly from the issuer, Global X ETFs. Focus on the weightings of the top holdings. If a small number of companies constitute a significant portion of the ETF's net assets, it suggests a higher concentration risk. Impact of concentration risk. Volatility. If a few companies with significant weightings within BUG experience negative performance, it can have a more pronounced impact on the overall performance of the ETF compared to a more diversified holding structure. This can lead to higher volatility in BUG's share price. Individual company risk. The fortunes of BUG are more closely tied to the performance of a few companies if there's high concentration. If a key holding company experiences a major setback, legal issues, or a security breach, it can disproportionately impact BUG's performance. Mitigating factors. Index diversification. The INF Cybersecurity Index might be designed to incorporate a certain level of diversification across different subsectors within the cybersecurity industry. This can help spread the risk and reduce the impact of any single company's performance on BUG. Market capitalization weighting. If the index weights holdings based on market capitalization, it might result in a higher concentration in larger, more established cybersecurity companies, potentially offering some stability. Investor considerations. Concentration risk is an inherent feature of thematic ETFs, like BUG, that focus on a specific industry. Investors with a lower risk tolerance might want to consider broader market ETFs or actively managed funds that offer more diversification. By analyzing the holdings and weighting structure of BUG, you can get a better sense of the concentration risk and make an informed decision based on your risk tolerance. Question 8. Are there any other ETFs in the market that offer similar exposure to the BUG ETF's target market segments? Yes, there are several ETFs in the market that offer similar exposure to the BUG ETF's target market segments within the cybersecurity industry. Here's an overview of some potential alternatives. Competing cybersecurity ETFs. ETFMG Prime Cybersecurity ETF, CHKR. This ETF tracks the MVIS Global Cybersecurity Index, offering exposure to a diversified basket of companies globally involved in cybersecurity solutions. LAT Cyber ETF, HAC. This ETF tracks the Solactive Global Cybersecurity Index, focusing on companies that develop and deliver cybersecurity products and services. CTXR Global X Cybersecurity Thematic ETF, BUGZ. This is another offering from Global X ETFs, but with a slightly different approach. BUGZ tracks the ISE Cybersecurity Index, potentially providing exposure to a different set of companies within the cybersecurity space compared to BUG. Key considerations when comparing alternatives. Underlying index. Each ETF tracks a different cybersecurity index, potentially resulting in variations in holdings, weightings, and geographic exposure. Research the specific index methodology and composition for each ETF to understand the nuances. Expense ratio. Compare the expense ratios of different ETFs. A lower expense ratio translates to a higher net return for investors. BUG has a competitive expense ratio of 0.50%, but it's worth comparing it to alternatives. Liquidity. Analyze the average daily trading volume, ADTV, for each ETF. A higher ADTV suggests better liquidity and potentially tighter bid-ask spreads, making it easier to enter and exit your investment position. Performance. While past performance isn't always indicative of future results, you can compare the historical returns of different cybersecurity ETFs. However, keep in mind that the cybersecurity sector itself is still evolving, and past performance might not be a reliable predictor. Additional options. Broader technology ETFs. Some technology ETFs might allocate a portion of their holdings to cybersecurity companies. While not offering pure-play exposure to cybersecurity, this can provide some diversification within the broader technology sector. Actively managed mutual funds. Actively managed mutual funds dedicated to cybersecurity might offer more targeted exposure and potentially outperform the broader market, but with higher fees compared to passively managed ETFs. Question 9. Are there any actively managed mutual funds that invest similarly to the BUG ETF? How do their expense ratios and performance compare? Yes, there are actively managed mutual funds that invest in the cybersecurity industry similarly to the BUG ETF, Global X Cybersecurity ETF. However, there are key differences to consider, including expense ratios and performance. Actively managed mutual funds versus BUG ETF. Investment approach. BUG is a passively managed ETF that tracks a specific cybersecurity index. Actively managed mutual funds, on the other hand, employ portfolio managers who research and select individual companies within the cybersecurity space based on their investment thesis. Potential for outperformance. Actively managed funds aim to outperform the market or a specific benchmark, like the index BUG tracks, through their selection and management of holdings. However, this doesn't guarantee success, and many actively managed funds underperform their benchmarks. Expense ratios. BUG ETF, expense ratio of 0.50%. This represents the annual fee charged by the ETF to cover operational costs. Actively managed funds. Expense ratios for actively managed cybersecurity mutual funds can vary but typically range from 1% to 2.00% or even higher. These higher fees reflect the costs associated with portfolio management research and analysis. Question 10. Are there any option strategies you could use to replicate the BUG ETF's exposure while potentially managing risk or generating income? Here are some option strategies you could consider to potentially replicate BUG ETF's exposure while managing risk or generating income. Replicating BUG with options. Directly replicating BUG's exact holdings and weighting methodology through options contracts can be complex and expensive. However, here are some alternative strategies that might achieve similar exposure. Covered calls. Mechanics. Sell call options on BUG, or a similar ETF, while holding the underlying shares. This generates income from the premium received for selling the call options. However, if the price of BUG rises above the strike price of the call option by the option's expiration date, you might be obligated to sell your shares at the strike price, potentially foregoing further gains. Risk-reward. Covered calls limit your potential upside but provide some downside protection and generate income from the premium. This strategy can be suitable if you're bullish on the cybersecurity sector but want to hedge against potential downside or generate additional income. Cash-secured puts. Mechanics: sell put options on BUG, or a similar ETF, while holding cash equal to the strike price of the put option. If the price of BUG falls below the strike price by the expiration date, you will be assigned shares of BUG at the strike price. This can be a way to potentially acquire BUG at a discount if the price falls. Risk-reward: cash-secured puts offer the potential to buy BUG at a lower price, but tie up your capital during the life of the option. This strategy can be suitable if you're bullish on the long-term prospects of the cybersecurity industry, but want a potentially lower entry point. Important considerations: selection of options contracts. Choosing the appropriate strike price and expiration date for your options contracts is crucial. Consider your risk tolerance and investment goals when selecting these factors. Ongoing management: option strategies often require ongoing monitoring and adjustments. You might need to close out or roll over your options positions before expiration, depending on market conditions. Transaction costs: options trading involves transaction fees associated with buying and selling options contracts. These fees can eat into your returns, so factor them into your calculations. Alternative income generating strategies. High dividend technology ETFs. Some technology ETFs, while not purely focused on cybersecurity, might offer a higher dividend yield compared to BUG. This can be a way to generate income within the broader technology sector. Alright everyone, that's all the buzz on the BUG ETF. We explored the BUG ETF's investment strategy, potential risks like concentration and liquidity, and how it compares to other cybersecurity ETFs. We also discussed exciting, but remember, risky, options strategies to potentially replicate BUG's exposure while managing risk or generating income. Remember, options trading involves significant risks and isn't suitable for everyone. Do your own research before diving in. No matter your approach, the cybersecurity industry is a fascinating space with huge growth potential. So, if you're interested in getting involved, the BUG ETF is definitely a contender to consider. Let us know in the comments below what you think about the BUG ETF. Is it a good fit for your portfolio? And don't forget to like this video, subscribe to the channel for more in-depth ETF explorations, and hit that notification bell to stay in the loop.